Stop. Stop scrolling. Stop assuming what just happened is normal market behavior. Because in the final hours of 2025, while screens looked calm and New Year's Eve plans filled the room, something very different was happening off screen. Something violent, something structural. 3 margin hikes. 1 month, silver still standing. This is not volatility. This is system stress, and it is happening right now, not yesterday. 3 margin hikes is not control, it is panic. Let us slow this down, because when an exchange raises margin requirements once, that is risk management. When it raises them twice, that is concern. When it raises them 3 times in a single month, that is panic. In December alone, the futures exchange raised margin requirements on silver 3 separate times. Early December, December 26th, December 31st, the final trading day of the year. Think about that timing. They did not wait for January. They did not wait for liquidity to return. They did not wait for desks to be fully staffed. They acted on the last possible day because the pressure did not take a holiday. Margin hikes exist for one reason: to break rallies by forcing leveraged players to liquidate. That playbook worked before. In 1980, a single intervention crushed silver from $50 to $10. In 2011, 5 margin hikes in 9 days killed the rally near 50. Those were leverage-driven markets. Those buyers could be forced out. Now look at 2025. 3 margin hikes in roughly 30 days. And silver is still trading near 71. That alone tells you everything has changed. If the first hike had worked, there would be no second. If the second had worked, there would be no third. The repetition is the message. This is not control. This is delay. The exchange is throwing tools at a fire that no longer responds to them. Because the buyers supporting this market are not trading on leverage, they are buying with balance sheets. With cash, with necessity. And margin requirements do nothing to people who are not on margin. That is why price did not collapse. That is why 70 did not break. That is why every forced liquidation was absorbed. This is the moment the old playbook stopped working. And when suppression tools fail, markets do not normalize. They reprice. Price action that refused to die. Now look at the price action, because this is where most people get fooled. On the final trading day of the year, silver opened around 70. After the 3rd margin hike, after forced liquidations, after everything that was supposed to break this market, overnight, price dipped toward 70. That part was expected. Margin hikes trigger margin calls. Margin calls force selling. Weak hands get flushed. That is how suppression is supposed to work. But then something happened that was not supposed to happen. Buyers stepped in, not slowly, not cautiously, aggressively. Price climbed from around 70 to the mid-70s during the same session. A $6 move upward in a single day. That is not surrender. That is demand. By the close, silver settled near 71, not 65, not collapsing into the abyss. Right back where it has been holding for weeks. Stop and think about what that tells you. After 3 margin hikes, after extreme volatility, after forced selling, the market did not break. It absorbed the shock. That tells you there is a floor. And that floor is not set by paper traders. At 70, at 71, at 72, buyers appear. Strong buyers. Buyers who are not scared by volatility. Buyers who do not care about margin requirements because they are not trading on margin. They look at 71 silver and they do not see danger. They see discount. These are not retail traders clicking buttons on a phone. They are not hedge funds running leverage. Those players were flushed out weeks ago. The buyers left in this market are industrial manufacturers securing supply. They are strategic accumulators. They are balance sheet buyers. When price dips, they do not panic. They execute. That is why price bounced. That is why 70 held. That is why suppression failed to push price lower. In a real collapse, price does not bounce. It bleeds. It accelerates downward. This market did the opposite. Every attempt to break it was met with buying. That is not weakness. That is resilience. And resilient markets do not stay suppressed forever. They build pressure, and pressure does only one thing. Eventually, it releases. Paper price versus physical reality. Now we need to talk about the part of this story that never shows up on the screen. The part that never makes headlines. The part that tells you whether a market is healthy or already broken. Paper price versus physical reality. While silver was printing 71 on your screen, something very different was happening in the real world. Go try to buy physical silver right now. Not a futures contract. Not an ETF. Not a promise. Real metal, bars, coins, delivery. What do you see? Sold out, pre-order, delayed shipment, expected availability weeks away, and when metal is available, the price is not 71. It is 85, 90, in some markets, over 100. Stop, let that sink in. Paper silver at 71, physical silver trading 20 to 40% higher. That is not a premium. That is a warning. In a normal market, premiums are small. $1, maybe 2 or 3 to cover minting and distribution. When premiums blow out to $20, $30. That tells you something critical. Arbitrage is broken. Because if arbitrage were working, traders would buy paper at 71, stand for delivery, convert it to physical, and sell it at 85. That process would close the gap. But the gap is not closing. It is widening, which means paper cannot be turned into physical in meaningful size at any reasonable cost. This is not speculation. This is mechanics. When paper price dropped violently from the mid-80s to the low 70s, physical should have followed. That is what healthy markets do. Price falls. Supply floods in. Premiums collapse. Inventory refills? None of that happened. Physical holders did not sell. Dealers did not restock. Premiums did not fall. Scarcity did not ease. That tells you physical holders do not believe the paper price. They are looking at 71 and saying, this is not a market price. This is a liquidation print, forced selling, margin-driven, temporary. If 71 were the real price, metal would be everywhere. You would be able to buy silver all day long with normal premiums. But you cannot, because 71 is not where supply meets demand. It is where leverage was forced out. The real price is being discovered in the physical market, not on a screen. And that is why this is no longer just a spread. This is a separation, a divorce. Paper silver is doing what paper always does under stress. It lies. Physical silver is doing what physical always does under stress. It disappears. And when physical disappears, price does not drift. It resets. Who is actually buying and why margin no longer works. To understand why 3 margin hikes failed, you have to understand who is still buying, not who is buying. Who is buying right now? Because the buyers supporting silver at 70 are not the same buyers from past rallies. They are not retail traders chasing momentum. They are not hedge funds running leverage. They are not speculators trying to flip paper contracts. Those players are gone. They were flushed out by the first margin hike. They were finished by the second. They did not survive the third. So who is left? Industrial buyers. Factories that need silver to operate. Solar manufacturers securing input before prices rise further. Electric vehicle supply chains locking in material. Defense contractors meeting production requirements. State-level entities building strategic reserves. These buyers are not price sensitive. They are delivery sensitive. For them, the question is not, what is the price today? The question is, will the metal be there tomorrow? Think about the math from their perspective. If a solar panel manufacturer loses silver supply, production stops. If production stops, contracts are missed. If contracts are missed, revenue disappears. Paying $10 or $20 more per ounce is irrelevant compared to losing millions in revenue. So when price dips to 71, they do not hesitate. They buy, and they buy with cash. Margin requirements mean nothing to a buyer who is not borrowing. You cannot margin hike a factory into selling its inventory. You cannot margin hike a defense contractor out of production. You cannot margin hike a sovereign buyer into canceling accumulation. That is the flaw in the old suppression model. Margin hikes only work on leverage speculation. But leverage is no longer what is driving this market. Necessity is. This is why every dip is absorbed. This is why 70 refuses to break. This is why the exchange keeps escalating. They are using a tool designed for a market that no longer exists. In 1980, buyers were speculators. In 2011, buyers were retail investors. In 2025, buyers are industrial. And industrial demand does not panic. It plans, it accumulates. It secures supply. This is the moment the balance of power shifts. When price is set by people who need the metal, not people who want to trade it. And when that happens, suppression loses its leverage. Because you cannot force out a buyer whose business depends on delivery. You can only delay them, and delay does not remove demand. It concentrates it. The math of the deficit. And why the numbers do not work. Now let us strip away the narratives. Strip away the opinions. Strip away the headlines. And look at the math. Because math does not care about margin hikes. It does not care about policy statements. It does not care about suppression. Global silver supply comes from two sources, mining and recycling combined. That supply adds up to roughly 850 to 900 million ounces per year. Now look at demand. Industrial demand alone is approaching 600 million ounces annually. Solar panels, electric vehicles, semiconductors, defense systems, artificial intelligence infrastructure, add investment demand, add jewelry demand. Total demand pushes well above 1 billion ounces per year. That creates a structural deficit, not a temporary shortfall, a structural gap, roughly 200 to 400 million ounces every single year, depending on whose estimates you trust. Now ask yourself a simple question. Where does that metal come from? It does not come from higher prices immediately. Mining takes years to respond. Permits, capital, infrastructure. Recycling does not surge just because paper price spikes for a few weeks. Supply is slow, demand is not. Now layer in what is happening beneath the surface. Vault inventories are falling. Registered metal available for delivery is shrinking. Industrial buyers are not rolling contracts. They are standing for delivery. At the same time, the paper market is sitting on massive short exposure. Estimates vary. But even conservative numbers suggest hundreds of millions of ounces sold short on paper. Now run the stress test. If just 10% of those paper shorts demanded physical delivery, tens of millions of ounces would be required immediately. Where does that metal come from? Not from vaults that are already being drained, not from mines that cannot accelerate overnight, not from dealers with empty shelves. The math does not balance. That is the core problem. You cannot satisfy industrial demand, investment demand, and paper obligations with a shrinking physical pool. Something must give. There are only three possible outcomes. Option 1, price rises high enough to destroy demand. Ask yourself, at what price does the solar manufacturer stop producing? At what price does defense production stop? Those prices are far higher than where silver trades today. Option 2, the paper market breaks. Forced cash settlement, rule changes, delivery restrictions. Paper survives by disconnecting itself from physical reality. Option 3, both happen. Price reprices violently upward while the paper market restructures to protect itself. Every margin hike points toward this reality. They are not solving the deficit. They are trying to delay its consequences. But deficits do not disappear because you raise margins. They disappear only when price adjusts. And the longer that adjustment is delayed, the more violent it becomes. This is not speculation. This is arithmetic, and arithmetic always wins. From suppression to discovery, and why this is the turning point. This is the part most people miss. Markets do not break when they are weak. They break when pressure has been building quietly for too long. 3 margin hikes in 1 month did not stop this market. They exposed it. They told you that suppression is no longer working. They told you that the old tools are exhausted. They told you that the exchange is reacting, not controlling. This is not a dying rally. This is a market transitioning. From suppression to discovery, for decades, paper set the price because supply was abundant, because metal was available, because delivery was assumed. That world is gone. We are no longer in a surplus market. We are in a deficit market. And in deficit markets, price is not negotiated on a screen. It is dictated by whoever controls the last available ounces. Physical holders did not sell at 71. They did not sell at 70. They did not sell after 3 margin hikes tried to scare them out. That is the signal, not headlines, not commentary. Behavior. When informed holders refuse to sell, price does not drift lower. It compresses. It coils. And when recognition finally hits, price does not climb politely. It gaps. This is how every major repricing begins. Confusion first. Suppression second. Resilience third. Then recognition. Most people never make it past the waiting. They are not broken by price movement. They are broken by time. Volatility is the cost of conviction. And conviction is the only position the market cannot liquidate. As we move from the end of 2025 into 2026, the setup is clear. Supply is constrained. Demand is inelastic. Physical is scarce. Paper is stressed. 3 margin hikes failed. That is not noise. That is information. In surplus markets, paper sets the price. In deficit markets, physical does. And once that shift is complete, there is no going back. Stay steady. Stay patient. Stay positioned. The recognition phase does not announce itself. It arrives all at once. And when it does, this price range will look very far away. I will see you on the other side of discovery.